Morning, everyone. Really happy to bring to you Chapter 5 of the Real Estate Investing 101 class. Again, this is a free class I signed up to create because I thought there was just a lot of people out there trying to sell real estate investing advice. And I thought, given that I've been doing it for 15 years, read hundreds of books, that I thought I'd at least take a shot at putting some free content out there, breaking this up into 6 different chapters. And the good news is we're one chapter away from being done. So this is chapter 5. It has taken me a little bit longer to pull all of this together as I wanted to make sure we created some decent content for you. So we're going to go ahead and get into this chapter. It's really about 1031 exchanges and kind of other tax advantages that you can, first you need to understand, and then understand how you can leverage them through your investing career. But before we do that, you gotta do these first 3 things. Do me a favor and hit subscribe. Share this channel with friends and family. We're trying to put out free stuff to help people. So if you can share via your social network, that would be great. Hit the like button. That gives me kind of feedback on the individual videos I'm putting out, making sure that we are, helping where appropriate. And as always, leave a comment. I do my best to get back to all of these that I can. They are, I'm a one-man show, so I will reply when time permits. So with that, we'll go ahead and get started. So, we're going to go through kind of the basics of a 1031 exchange. If you've read my book, you know that we took advantage of doing 7 or 8 1031 exchanges back in 2008. It proved to be outstanding timing, and we were able to shield our equity that we'd built up in the single-family housing markets because we moved all that, via an exchange into some apartment buildings. So again, 1031 exchange is something that is very beneficial. We're talking about why we used it, when we used it, sort of highlight this in detail, put some numbers behind it. We're going to talk about depreciation. I don't think, again, if we're treating this as a 101 video, I'm going to make sure we talk about it. Also going to highlight depreciation recapture, just so we can talk about what that is and when that comes to bear. We'll talk about just general operating deductions that will allow you, to file on your taxes and all of that. We'll talk about refinance proceeds, just to, throw it out there. We'll touch on this a little bit more in the next and final chapter, but I just want to put some math out there and make sure we're all on the same page. And then finally talk about what's called a step or stepped up basis. All right. So a 1031 exchange, just the basics, right? And I'll give you what I have. I'll give you from my experience. But there's, lots of stuff out there if you want to get into the detail. First and foremost, it starts with a like-kind investment, right? So you're going to trade, in my example, a rental property for a different rental property. You will not trade a rental property for an owner, a primary residence. Doesn't qualify. Like you won't be able to trade a primary residence for a rental property. Not going to qualify. However, you can exchange a house for an apartment. You can exchange an apartment for a house. Now, assuming the exchange is, more valuable and, higher numbers and, all of those. So there are other rules around this, that the basis of the new purchase or the purchase price has to be larger than the sale price of the other one, because that's the beauty of the exchange, is they want you to get bigger. That's kind of the encouraging thing that they're doing with this. But again, so it's like kind. So rental property for rental property. And again, what we did was we took houses, and in one case a duplex, and exchanged them for small multifamilies from 5 to, I think, 18 units. It was very beneficial. And again, what you'll do is you'll take all the equity that you have in the house, and you'll be able to move that into the purchase of another property. There are some significant time limits. There are no exceptions. Drill in and understand what these are via more research. First thing is you get 45 days, right, since the close of the sale of the first property, to nominate properties. Now you can nominate multiple. I've seen, write-ups of up to 3. So you don't have to close on all 3, but you're basically saying, I'm going to close one of these 3 properties. And then you have 180 days, again, from the start to actually close on this second purchase. And the last thing is you're not holding on to any proceeds, right? There's an intermediary, or you can think of it as an exchange officer, sort of holding the proceeds for you. You can't touch. It's sort of, think about like a 401k. right? You can't touch the proceeds. You can't touch anything. You can't put them in a money market account and promise not to spend them. It's just none of those things. You can't touch them. They never can enter one of your accounts. It has to go to this exchanger. So hopefully that makes sense. Again, we use this to protect ourselves. In the beginning, we didn't do it for that reason, but we couldn't buy any more houses. So we decided to sell what it turned out to be the top, and we moved all that artificial equity, which was really fake, into apartments. And then when the bottom fell out of the market, we looked like geniuses. So again, right, we made a conscious decision that we couldn't buy the next single family home. And instead of making a bad deal, or worse, making no deal, we sold. We couldn't find anything that was monthly cash flow. So we got into apartment buildings. This turned out to be a wise investment, because what we were doing was selling houses that rented for, call $1,100, and we moved it into apartment buildings that were renting from $2,500 to $10,000, and then the cash flow was much, much higher. So we were able to move that equity when the housing crashed. Certainly our apartments also fell in value, but again, we weren't worried about net worth. Our cash flow actually went up because rental rates got stronger. Occupancy went up as people kept losing houses. So again, we looked like genius. So depreciation, make sure that you understand how depreciation works. There's kind of three things to talk about. There's the purchase price, the building, and land value. Right. So when you buy a rental property, one of the things that's going to happen is you're going to declare, the tax man's going to declare, right, what the land value is, and then what the building, the structure, is actually worth. Why is that important? There's lots of reasons, but the main one for this discussion is land doesn't depreciate. Right. So we'll go through the math here in a little bit, but you will be separating land value from structure value. Also, as you might imagine, there are different, I don't know what you want to call them, curves or, years of depreciation. So residential, so you can think of this as 4 units and below, they have a depreciation schedule of 27.5 years. And commercial, so think 5 units and above, and our speak, it's 39 years. So here's the math we're going to do. So let's just assume for this example, and I would challenge you to take out your calculator and walk through this with me. So if you don't have your calculator or your phone with you, just hit pause and go get it. But let's just say you bought something for $189,000. Let's just say for grins that land value is $40,000. What does that mean? That means the house or the structure is worth $149,000. So given it's a house or residential, you're going to divide that by 27.5. Right, that's the years that a residential property depreciates. That should end up with $5,418 in yearly depreciation. Now what I do is always turn that into a monthly number. So take that 5,418 and divide by 12. My calculations show that that's $451 in monthly depreciation. And depreciation is one of those non-cash expenses. So what that really should mean for you is if you have this $189,000 house, if you have positive cash flow of $451 or less, you're going to be paying zero taxes because depreciation is going to hide those $451. Now, if you have $500 in cash flow, right, $49, using quick math, will be eligible for taxes because that will be profit above and beyond what the depreciation is going to shelter for you. So understanding depreciation, how to use it, is very, very, very powerful. It is something that is often talked about but not well understood. So I want to make sure we included that in our 101 class. So again, operating deductions, just want to make sure you understand, right? You'll be able to take off the interest of the loan. You'll be able to take off the property management fees. You'll be able to take off the insurance, property taxes, repairs, and of course depreciation. Remember, depreciation, unlike the first 5, is not a cash expense. Right? You're not actually writing a check for our example above of $451. It's just given to you. I do want to talk about here depreciation recapture. So I think in our example we had the property worth $149,000. Let's just say you've held it long enough where you've deducted $49,000 in depreciation. Right? You're with me? So now you have $100,000 left, plus the $40,000 in land value, right? So what you've done is you've written off $49,000, but now let's say you sell it just for grins at $250,000, right? Your basis is going to be $140,000. So when you sell it for $250,000, right, ignoring real estate commissions and taxes and transaction fees, you're going to show a profit of $110,000, right? Write this down with me just so you're with me. So $149,000 was your original property value. You subtract $49,000, that equals 100. You add back in the land value from the earlier example. So 100 plus 40 is 140. You sell that for $250,000. There's a spread of $110,000. That is going to be your profit from the sale of that, because that is called depreciation recapture. You don't get to write off depreciation and not pay it back later. That's why a lot of real estate people use 1031 exchanges. That is why they don't sell, and frankly why they go and use the stepped up basis, which we'll close this section with. So what about refinance proceeds? You know, instead of selling, maybe you just want to refinance it, right? You've owned it 5, 10, 15, 20 years, and you want to take some equity out. What happens? Well, let's do the math. Let's just say that your house is worth $200K after 5 years. Let's say you owe $100K. Let's say you do a refi at 70% LTV, which stands for loan to value. So 70% of 200 grand is $140,000. Hopefully you're with me. $140,000 minus 100 you owe, again ignoring, transaction fees and points and appraisals and all that stuff, leaves you with a net of $40,000. The question for you is the $40,000 taxed. You think you'd pay taxes on that? The answer is no. That's why a lot of real estate people will have multiple properties, and every decade or so they'll refinance, pull money out, and just keep this machine rolling. All right, so the final chapter, stepped up basis. Right, there's a saying out there that death and taxes are the two things you can't escape. Right, you've heard that. Well, what happens to real estate property that you own when you die? Anyone know? Well, just like it's an asset, so you get to pass it on to your heirs. But how do you pass it on? Right, what happens? Right, do they inherit your basis? Do they, what happens to it? It's sounds big, hairy, and scary. Well, the good news is it's very good for you, or very good for your heirs. But let's go through a big example. So let's say you bought a property for 200 grand, you owned it for 30 years, it's paid off, it's cash flowing great for you, you're enjoying life. You've depreciated it to zero, right? But meaning you've depreciated whatever that purchase price is down to zero. So you never want to sell it because you got a cost basis of zero. But again, you passed away after living 110 years or whatever it is. Let's just say the property's worth $425,000 now, but again, remember your cost basis is zero. So if you were to sell, the last day you were living, you would pay taxes on the $425,000 because it's pure profit. But you pass away, right? You're 110 years old. You go in your sleep, all that good stuff. You pass it on to your heirs, your sons and daughters, aunts, uncles, sister, brother, mother, whatever, and they get to take it in what's called a stepped up basis. So they take it over it, and the new value is established at 425, and they get to start the depreciation cycle all over again. Let's just assume it was a house. They get to start taking depreciation at 425, whatever, minus land value, and they get to start depreciation again. So in essence, you've escaped paying taxes because you've passed on. Just another great tax benefit available for real estate investors who use conservative financing, hold for the long term, and something I recommend. I don't generally recommend selling. Exchanging is a great idea. Selling is just a taxable event, and it forces you to pay the IRS or in-state and all that good stuff. So use refinancing. Hopefully that came through. Use depreciation to hide positive cash flow, and then know that when you pass on, you'll be able to move those assets to your heirs. So in the end, the final chapter is just all the ways to exit. We'll talk about paying off your real estate, exchanging again, refi, sell, or just pass on, right? If you pass on again, the sort of stepped up basis. But again, if you've gotten this far, do me a favor, hit the like button for this video, hit subscribe. Please share this channel with friends or maybe recommend me for other podcasts. That would be great. If you know of another podcast I should be on, go ahead and leave that in the comments. All right, have a great day.